Well, here we are, folks. How are we all? It's another Tuesday evening, and we'll just put the pre-show on for a moment or two, just running up to 8 o'clock start. My dogs are confused. We're an hour earlier, of course, here because your time's changed in Australia, but they haven't changed here yet. They will in a couple of weeks. And so the dogs are sort of sitting here saying, what about lunch? I normally feed them beforehand. So she's just come and given me a nudge, but she's gone back to sitting now. So we'll see whether that lasts. Of course, Damien is also here ready to come in. You can see him over there, teed up, ready, and got a slightly different setup this time. So it'll be interesting to see how that runs. Everything else is running here. We've got, the multi-view. We've got the chat. We've got a few charts and things loaded and ready to go. And, well, we should have fun. Really big conversation today. A lot to talk about. There is a lot of unknown unknowns at the moment, specifically about the question of, how where are markets going? What does it mean? Are we going to melt up to the end of the year or not? And all of those questions. So we're going to have a really interesting conversation. And Damien's got some specific research to share as well, which is going to be, I think, quite interesting. So should be a fun show. And take the pre-show off. I'm going to start the show properly, and I'll be back in just a moment. Well, good evening and welcome to this live stream on the 7th of October 2025. It's Martin North here from Digital Finance Analytics. Great to have you on board this evening. Thank you for taking some of the time out of your Tuesday evening to spend it with us. Really appreciate it. Going to have a really interesting conversation with Damien today about all things markets. Are we boiling up for a higher peak at the end of the year? Is it being driven by the AI story? Is the AI self-investment mutual reinforcing cycle actually to blame for that? Is it to do with the Trump trade? Is it to do with the tariffs? Or what about the debasement trade? Gold and silver and even Bitcoin are all tracing higher at the same time that the S&P 500 is tracing higher, which is a bit unusual. So there's a lot of interesting questions. Bond yields, bond rates are rising as well at the moment. So there's a lot to try and unpick. And we're going to try to get into some detail tonight, specifically around some of those AI questions. So that should be really interesting. Before I bring Damien in, remind you, of course, we're not providing specific financial or legal advice. It's a general conversation only. We moderate the chat, but feel free to throw your questions, comments, and suggestions as we go. I won't necessarily follow all of the conversation points because there's always a lot of activity. But if you'd like to get your question to me or Damien, if you use @WalkTheWorld, that'll get my attention. I've also enabled Super Chat, which means that if you want to make a contribution to what we do around here, it's greatly appreciated. Or indeed, get your question to the top of the list. And that's a way of doing it too. And thanks for all those who support us via Patreon, via the Super Chat, or via PayPal. It's really appreciated. It helps us to do this. We don't do this for profit. We do this because we think it's a really, really important conversation to be had. So let me bring Damien straight in. Damien, welcome back. Thank you very much for coming on again.
Thanks, Martin. Great to see you again.
Very interesting times for markets. And, we discussed a month ago and, there was a question of, well, are we going to get a weak September, a correction or something like that? And, no, markets have continued to drive higher and everybody seems quite enthusiastic now about markets are going to go higher, well, into the end of the year.
Yeah, absolutely. I just wrote something, yesterday, day before, and I did a little bit of a podcast on some of this valuation stuff, and then jumped into that released yesterday, just talking about how it really is this, in terms of valuations, it really is that top 2% that's looking expensive. It's actually surprising how a lot of the other sectors actually look relatively cheap. Some of them.
Yeah, and I do think there is a very important story here that you've got to sort of segment and analyze quite granularly to really understand what is going on. You can't just sort of ride the overall index up and say, see, the index is up. No. When you actually look closely, it's a bit of the index that's driving the whole of the index. And look, we'll get into this, but I am amazed that OpenAI is effectively getting into these relationship agreements with places like Oracle and AMD and they're going to throw a lot of money between each other. Stock market reacted very positively when AMD went through the roof and Oracle went through the roof. OpenAI is a private listed company, so they aren't actually on the index themselves. But it does feel a little bit sort of Ponzi-ish to me. So that's sort of one question I want to explore. The other one is this debasement conversation. So JP Morgan came out with a note and said, well, of course, gold and silver and et cetera, even Bitcoin, that's just a symptom of the debasement trade. Because, of course, there's a lot of questions about the amount of debt in the system and governments still writing more debt. And to which I reply, well, that's a really interesting conversation. But you've got to understand, the government is not going to reduce the amount of debt in the system. They can't do that. If they did, the system would collapse. So we're going to see more and more debt, not less debt. And then the other question, in all of this is the sort of the latest in the tariff story and what's going on there, and the fact that we haven't yet got much good sense of what's going on. And we've got the shutdown in the US, which means the information flows are now being strangled as well. So, we are in really interesting times.
Yes. I think we spoke about last time, did we? Just around the idea that, look, we're already at the part where the quality of the data is going to be getting worse, just because they're firing the heads of statistics groups and stuff like that. And I think they've finally given up on the guy they were trying to ramrod through that. I think they've given up on. So I think that position's empty at the moment. But it is that thought that, look, there are lots of other sources of alternative data, and people sort of chasing the various models to get through. And so, at any time, if you feel you've got a good grip of everything that's going on, you're probably wrong. And right now, it's even more likely you're wrong. And there's probably other people out there. Well, there's plenty of other people out there who have alternative data and listening to alternative things, and might be basing their views off something different, completely different. And so, trying to work out whether is my data the right data, or is their data the right data? And come up with that is going to be key.
Well, it seems to me actually a lot of it comes back to almost religious beliefs. If you have a very strong belief that the future of AI is going to radically transform everything, and those AI companies have the capacity to sort of drive massive change and transformation through the entire economy at one end of the spectrum, then you're going to be very bullish on AI and all of those things. If you're actually somebody who thinks, well, hang on a moment, the amount of government debt is booming, it's true in the US, it's true elsewhere, that is getting a bigger and bigger burden on the economy, and maybe that debt is going to be a problem. And of course, the shutdown in the US is partly about the question of debt, but it's also about the healthcare situation, which of course in the US is being the pointy end of the reason why there's a close down. You might have a different view, or indeed, I suppose if you actually have the view that, well, maybe the weakening of the dollar suggests that maybe the dollar's preeminence is being diluted now, and maybe that that you can make the story run almost any way you want. And I don't think there is definitive information to anchor any one of those views to the point of being 99% certain.
No, absolutely. And I think at the heart of this whole thing, though, and that was, I wrote something else probably a week or two ago and put a podcast out on that one as well. The heart of the whole thing, I think, is investors really should have a grip on what's happening in the CapEx boom in the US in AI, because that is what is driving, the bulk of this. And you really do need to have a feel for what the numbers are, where the money's coming from, where it's going to, what are the bits that are concerning, what are the bits that aren't concerning. And as you spoke about, there's some concerning things out there. And so, well, is it worth jumping in and talking Oracle now? Is that
let's do that. Let's start with that, because I think the OpenAI, Oracle, AMD, and all this is the pointy bit, and it gives us a bit of a clue, right? Because let's face it, they're grabbing money from nowhere to invest in something that doesn't exist yet.
Well, okay, so let's talk about the stuff let's talk about where the money is. So that's probably actually no. I think let's start with Oracle, because I think there is definitely a part where you say, okay, we have a company, Oracle, which has got a division in it, and sorry, and I should take one extra step back. A few years ago, if you looked at NVIDIA, they produced GPUs for computers, and mainly gaming chips and stuff like that. And that was a company. They also did a few other bits and pieces, and crypto getting calculated, but then that went away. But All of a sudden these data centers came out, and now the data center revenue just dwarfs anything else. If you're out there and you go, oh, their latest gaming chip wasn't that good, I'm thinking about selling Nvidia. It's a pimple on the on the butt now of the beast that's out there. Like that, Nvidia is just it's no longer a gaming company. Now Oracle sells databases, used to sell databases, because if what's happening in their data center division is true, they're increasing their sales by 10 times, 15 times over the course of like a year or 2 years. Like they're just literally add one more zero and maybe more to the division. And that just means the jump you've seen in price is not about it being a database company. It's about it being a data center company. Now, why are they a data center company? Well, look, in a way that they just sort of got lucky as well. Like, so what do you need in terms of these data centers? Now, one of the key things you need is people that know how to do this, and people, you need people that can buy the machines, plug them in, turn them on, and get the whole thing working. Now, they had a whole bunch of these people doing it because they're the people that were basically buying databases and or computers to run the databases on and plugging these things in and making them run. And so they had them. They started up a division in there. One of the interesting things with Oracle is that they're one of the only hyperscalers, or if you look and you go Google, Amazon, and Microsoft as the big ones there, they're the only ones that aren't trying to compete with all their customers. So if you're OpenAI, Google and Amazon are actually actively out there trying to set up with their own AI things. You've got both of them plus Microsoft as well are busy trying to get their own chips up to compete with Nvidia, and so you've got this, so they're both buying things from Nvidia and they're competing with it. Whereas Oracle's one is for both, at both ends of the scale. Nvidia thinking about how many chips should I sell and who should I sell them to, and also there's some of the people buying it is like, well, at least these guys aren't trying to compete with me directly, and so they're sort of like the fourth, maybe even fifth player at one stage, and they're sort of in that spot where now all of a sudden it's like, well, actually that makes sense for people to go to them rather than others. There's also this demand that for a lot of at some of the lower levels, it was, okay, I'm a medium-sized company, might be hundreds of millions of dollars in market cap and all that type of stuff like that, and I want to get these servers, but I just can't get them because when I turn up to Facebook and Google, they're like, oh, no, we've already sold that to people with much bigger orders than you. And so that's where Oracle sort of collected a bit more, or got it started, I guess, in terms of some of those. And so so you sort of go, okay, there's sort of reasons, there's the grains of truth behind this, so to speak. And then you go, well, they're raising $300 billion, taking a $300 billion order from OpenAI and another $50 billion probably from some other startups loss making. OpenAI, it's not even it's going to make like $13 billion in sales this year. So so you're basically relying on the fact that capital markets are going to be open and these guys are going to be raised capital is part of it. OpenAI is still a not-for-profit. Like they can't actually raise the capital. They're working on changing their whole system to be able to changing their, the structure of the company in order to be able to raise the capital, in order to be able to fund it. So, you're even further back behind that than before. So you've got this company. Now, how are they going to fund it? Now you've got Nvidia turns around and says, well, we're going to give, we're looking at investing $100 billion into OpenAI. And OpenAI is going to then give that money to Oracle, who's then going to give the money back to NVIDIA to buy their chips. Then the other thing is you look at, say you're looking through the Google, Facebook, all those, Google and Amazon and Microsoft. They're these hyperscalers. They've got these data centers. The data centers are very profitable. They're cash flow positive. Like they're making all this money from it, and then plowing a lot of it back into the fund next year's growth and the future growth. That's not Oracle. Oracle's, I'm sorry, and all those guys are largely vertically integrated in a lot of them. Like they own it all the way up and down the stream. Oracle's not there. Oracle's basically, for most part, they're in other people's data centers. So someone like an Equinix, a property trust, will own the data center. They're getting the hardware is coming in from NVIDIA. They're sort of sitting in the middle here. All these other people doing it. So they don't have the same control over the data centers. They're going into debt to do this. So all these other ones are funding it from their free cash flow. These guys are going into debt. They've got more debt to start with. And so they're sort of, a lower quality look at the same thing. But, and here's the crucial point, when you're in a boom, the lowest quality companies go up the most. So let's talk mining, because I think a lot of us train investors sort of fits and it makes the calculations a bit easier. Is you go, okay, we're in this iron ore mining boom. BHP, Rio, produce at $50 a ton or $40 a ton. Okay, so when the price is $100, these guys are making $50 or $60 a ton. So there's another company out there whose price is, let's say it's $99. Their cost is $99 when BHP and Rio are making $40, $50 a ton or $60 a ton. It's making $1 a ton. So, much lower quality, much higher cost. Now the price goes from $100 to $110. BHP's profit goes from, say, $60 a ton to $70 a ton. So great, but it's up a little bit. This other one's gone from $1 a ton to $10 a ton. Like their share price goes up a lot more. You go to 130 and all of a sudden it's gone from, the next jump, it's gone from $10 to $30. Whereas, BHP and Rio, they've gone from $60 or $70 to $80, $90. It's still BHP Rio. They're much more high quality company. If the whole boom comes to an end, then these guys are gonna survive, and you don't have to worry, is the company going to be there or not. But if you're looking at these other low quality companies, if the boom extends for a longer period of time, they're the ones that are going to make the most money and won't be priced in. And that's how I'm thinking about Oracle is, and also it's right now it is a lower quality look at it. But if the boom goes on for 4 or 5 years, then maybe they pay back all their debt. Now they're actually one of the biggest ones out there. They might even be, based on some of these numbers, they might end up being the biggest one. And because they're not trying to compete with all their customers, maybe they get, they end up being the preeminent one. They certainly got lucky, I think, in some ways. But now it's whether they can make something of that luck. And they are stuck in the middle of this control where it's not their data centers often, and NVIDIA is sitting on the other side charging them lots for chips, and they haven't really got a lot of power in the middle. But there's heaps of pricing power in this at the moment. Everyone's trying to get these chips. Every bit of demand you can get, every time somebody can get more GPUs up and running, there's somebody willing to bid the price for it. It's sort of like this. You don't want to be too. You don't look at these companies and go, yeah, I know. Look at all these problems with it, because if the boom's there, these guys are going to do really well.
It is fascinating. And just as a sort of a contrast, of course, they also announced, this is OpenAI, a deal with AMD, right, which is one of the chip manufacturers. And guess what? AMD's share price shot up, dramatically, as you can see there, from around 160 to 100, 203. So there is a catalyst here when, in fact, these announcements come out. But I guess the thing you got to do, and what you're trying to do, is to say, well, where do they fit in the value chain? What leverage point do they have? What exposures do they have if things change? And trying to actually form an articulated view. So, for example, one of the things I question when it comes to all of this issue about the data centers is the energy costs. So how are they going to power the data centers? Is it going to be the nuclear investment? Is it going to be, I got lots of recycles? Yeah, because that's part of the story, right?
Yeah, actually give you one more investment though as well. Is NVIDIA is investing in, or looking to invest, who knows, it's always hard to tell with this stuff, in Intel. So, and people are like, oh, it's a recovery of Intel, and now they're going to be making NVIDIA chips for these guys do not have the ability to make NVIDIA chips. Intel's throwing a bit of money at them, but realistically, 10, 20 billion, whatever they're throwing at them. Yeah, look, it's a lot of money for you and I, Martin. But for NVIDIA, if this is the price they've got to pay to Trump in order to get to be able to sell their chips into China, because they're like, mate, we're your best buddy. You're trying to buy out Intel and put government money in there. We'll come and throw some extra money, and we'll throw some spare change in there. We're going to make 10 times from that if you let us sell into China. But it could easily just be the cost of doing business for them. And they do not have the ability to, if they do not have the ability to make the GPUs that NVIDIA has. Maybe they can get there. Absolutely. It's 5 years away. Like at best. So it's just not these are not the droids you're looking for. Yes. So there's it very much trying to work out which ones of these are which transactions are, is there something genuinely behind and which ones aren't. Yeah,
absolutely. And just on the Intel, this is the Intel share journey, and you can see that that's partly, of course, because of the US administration themselves taking a share in Intel as well as the other things. But
yeah, but if is that a 1 year chart?
That's from March. I can go back further if you want.
Yeah, give us like 10 years of it.
So that's from 2015.
Yeah, so it's been a long way down. You're you might be up 30 or 40% in the last bit, but you've still more than halved your money in even over a 5 year period. Yeah,
absolutely.
So yeah, it's look, it'd be nice if Intel does something, and maybe I don't know. It'd be nice if they come back and they're a force, and all that type of stuff. It'd be good to have more competition in this area, but they're a mess. they're a mess. They've been. I don't know how many managers they've been through. They've been through heaps of managers.
Yeah.
Well,
strategically, what are they? Where do they go? I suppose is part of the question. But look, I'm old enough to remember the tech boom and bust running up to the year 2000. And towards that, there were a lot of people throwing a lot of money into a lot of different areas to try and sort of keep that sort of series of tops spinning. Is this the same, or are there fundamental differences between the tech wreck back then and what we're seeing now? What do you think?
No, it feels very so. The Oracle transaction feels very similar. I think in a way, the shell game in 2000 was just a lot larger in that, a whole bunch of quite important differences. So a lot of companies raising money at ridiculous valuations. What were they doing with that money? Generally going and plowing it into other internet companies. We need to buy eyeballs was always the state of the play at the time, and so they're all out trying to get more people to watch their stuff and come to their website, and so they're all out raising money from the market and then buying advertising from each other, which then boosts the valuations of the ones you're buying advertising for because their sales and their revenues are higher and everything like that. It was all great until the market's just like, I think we've got enough. We've had enough, capital raisings. We're not going to do any more capital raisings. And then the music stopped, and all of a sudden, everyone's like, "Oh, but that's what I was relying on to do all my, my sales were 80% capital raisings and 20% real." And so all of a sudden, the 80% disappears, and that's so. I think there's that's what we have to worry about. Yeah. So, and I think we're jumping around a little bit. Let me just find the right slides for that. I'll show you what I think. So, what I think is this a snake eating itself? That's the question. Now, these are my figures, so you need to take them with a little bit of a grain of salt. I've got a chart up to sort of showing what I think these numbers are. And sorry, actually, just to highlight as well, I'll reiterate it as well. There is a report in the show notes you can jump in and grab, which goes into a lot of this stuff. So in the show notes you can click through and download a lot of these data. So we've got what I think is for the big hyperscalers, their own, and there are sort of what you call affiliated workloads. So it's Meta, Microsoft, Google, Amazon. I reckon that's somewhere between 35 and 45% of the amount of processing that's going on. Now, then you add in the startups like your OpenAI and Anthropic and these other sort of GPU clouds that are out there like CoreWeave, and now you're at sort of 2/3 of the market. Now, does that mean that this is 2/3 of it? Basically, use the right word for it, but it's self. So it's not sort of it's internally generated demand. And you go, well, somewhat. Like, so some of this is like OpenAI and Anthropic and all these people you're raising money, going out and then buying the space. So when these guys can't, at the moment everyone's happy to throw lots and lots of money at these guys to do more calculations. When that stops, okay, probably at least 1/3 of this will stop. I think there's probably at least another this third though that is just genuine stuff in terms of, look, some of it's Google and Microsoft and that doing their own thing, but some of it as well. Some of this they're doing their own calculations so they can also, Google's with a self-driving car, or they're doing something for their ads, or they're trying to improve their own processes. Like, there's stuff they're genuinely using and they can see a return on equity for it, and there's some of it that'll be speculative. And so, yeah, so I think there's probably at least a third of this is speculative. I don't know how much more. And then you get through what's the real economy side, and that's probably about a third of it as well. So 2/3 from these hyperscalers and the startups, 1/3 from sort of what you call real economies, which is financial services are in there, sort of banks, trading, risk, insurance, big one, insurance, all that type of stuff. So that's probably 10 or 15%. I think there's, that I don't see too much of an end to that. They're all out there, willing to spend the money because they're basically looking at this saying, well, if I'm an insurer, say, and someone else has come up with a system to generate to do all their claims, without using as many assessors, with using sort of whatever it is, a quarter of the number of assessors, then their costs are going to be much lower and their profits going to be higher, and they can bid the prices down. And so if I don't do this, I'm going broke in 5-10 years time if everyone else gets right. Then you get your sort of healthcare, pharma, biotech, drug discovery, imaging, all that type of stuff like that. That's probably about, I'm calling it 8 to 12, so it's 10% plus or minus a bit. Now some of that's is going, it's in the heat of the moment. People want to spend more on drug discovery and all that sort of stuff at the moment. So, but it's hard to, if everything came to a stop, there's probably a little bit of scope for that to fall. Auto, industrial, manufacturing, sort of all this sort of robotics and autonomy and all that sort of stuff is probably 5-8%. I think that's all pretty genuine, and that's just only going to grow over time. Media, consumer, internet, all that type of stuff like that. Consumer internet, gaming, I think it's probably about another 5 to 8. I think that's all pretty real as well. People want AI generated videos, and they're just complicated to make, and so there's stuff popping up all over the place. I think that there's probably growth in that. And then the last one's probably where the most growth is, I think, is that the government, defense, public sector. 3 to 6% at the moment. That could easily double or triple, and if you get a reasonable military breakthrough in terms of, say, drones or something like that in somewhere in AI, then every other country is going to want to throw as much as they can at it. And so, I guess where I'm getting to with this is there's a lot of real stuff behind it as well. So we've got 3 sort of big companies, Google, Microsoft, Amazon, that we go, yeah, these guys are genuinely making lots and lots of money, and there's lots of demand, and they're not doing this as at a loss or anything. You've got one company which is okay. There's quite concerning, that transaction, but if everything stays, if everything holds together for a few years, then then they'll have made the money, and they'll have built the data centers, and they'll have paid down their debt, and it's going to look it's going to look like a genius investment. So it's a real test of what you think of the capex cycle. If you think this is something that's a flash in the pan and it's going to be all over within the next 12, 18 months, then Oracle's a stock to short. That's one of the high risk ones. If you think, no, this has got, there's reasonable chance you're going to get just more stuff getting done, and militaries and competing for resources and stuff like that, then I think there's still some value within some of those low quality ones.
Right. And of course, you've got to place a bet, basically, haven't you? Where on that spectrum from, it's a flash in the pan and it'll be over in a year to 18 months, through to it's a fundamental transformational journey that we're on.
Yes. And I think there's 2 or 3 different types of bets you can have. One of them is saying, if you think this is right, is going, okay, there's some high quality ones within this. So if you're investing in your Googles and stuff like that, okay, they're a bit expensive at the moment, but they're not horrendously expensive. And we'll get back into some of the pricing later, because I think there's some other really interesting things on that. But you can sort of see where you can go, okay, well, they're expensive, not horrendously expensive. If things fall apart, this company's still going to be around. It's not going to have to worry about it as much, but I'm not going to make as much money if there's a mega boom. And then there's other ones, more like the Oracle or some of these, some of the startup type ones, where you're like, okay, if this finishes, these guys are toast. If it doesn't finish, this thing could go up 10 times in the meantime. And so, there's just that. I like to have a bit of bets in different places around on these.
Mm. And I guess the other question is, we're on this AI accelerated journey, but the chip development process is continuing. And so, are there going to be further breakthroughs? Could China come up with a step leap, for example, or could another company create a step leak. So that's another factor to bear in mind, because of course the energy demands is huge at the moment on the way that these things are running. And if there was a quantum move, and I picked that word deliberately, a quantum move into the computing world that could be fed into the AI world, you could have a whole new ballgame.
Yes. Now, there's a couple of parts to this. I've got a chart up just of the some of the different forecasts. So the IEA's got one. They've sort of got they're sitting at the bottom of the range. That's sort of got their headwinds case, which is like, okay, AI is having problems, and their base case is sort of like, this is what, this is the base rollout. But there's a pretty big difference. All these different lines or all these other forecasts that are out there. Semi-analysis, who's got some pretty bright guys. So I use them for the very detailed stuff. They're very, very good at the detail. And they're basically going, no, it's miles above where IEA is. Now, even if you sort of went through the semi-analysis one, there's a lot of demand for extra power. It's not that great relative to the rest of it. So it's certainly relative to our whole power system. So yes, it's increasing a lot, but on its own, if this was the only thing happening out there, I'd be like, we'll grow at 1 or 2% per annum. As a big picture from a world, how much extra power you're putting on, it'll all be fine. We're not in that case. So we also have, electric vehicles sort of launching and carbon concerns and people trying to electrify things and all. There's a whole bunch of other things going on. A lot of the older plant in countries, especially like Australia, where people have gone, well, we know these changes are coming. Let's not bother. Let's just let these things retire as they come about. And as they're starting to retire, and we're like, okay, we're adding all these extra capacity to replace them. As you're like, oh yeah, but you got to add capacity to replace these things are retiring. Plus, we've got all this extra demand coming on from electric vehicles, electrification, and now data centers. There's a bit of a thing there. The interesting thing on the data centers is it's not that expensive. Like, it's not a great cost for them. Let me just see if I've got some figures here. I've got some figures which are just sort of showing the cost of running some of these. I've got that. It's probably a little bit too complex for most people, for too much detail. But let's say we're talking about the latest, some of the latest NVIDIA chips, which is the GB200s. So basically, if you're running that, and you're a hyperscaler, so you're one of the big ones, you sort of 236 per hour is your cost. The Neocloud, which is sort of the next sort of group of core weaves and stuff like that, sort of you could add maybe 20% to those costs. And then just all these new ones that are coming out, their costs are maybe 30% above that. So that's your cost. If you look at it, you got this capital cost, which is let's say we're going to pick up the hyperscaler. So you $1.87 an hour. Your operating cost is like 50 cents per hour. So, and keeping in mind, these things are selling for, the longer term leases are like $6 an hour, and some of the shorter term stuff, you can get like 20 or $30 an hour for these things. So if you're selling this thing, and keep in mind that operating cost, that's everything in there. Like there's other, I think I've got some of these breakouts of these costs in here. Oh yeah, I do. Yeah. So your electricity cost is 9 cents out of that. So keeping in mind, so we've got 9 cents of our operating cost of $2.36 is power. We're selling it for like $6. Electricity price could go up 10 times. And you'd be looking at this going, well, so it goes up 10 times. It's no longer 9 cents. Now it's 90 cents. Rather than selling it for $6 to somebody, I'll sell it to somebody for $6.90. The people on the other end are like, oh, well, $6, $6.90, it's 10%, 15% more, but it's still getting the stuff I need. It's just not a large cost overall for these ones, and that's part of the problem. Is that data centers will outbid other people. They're like, well, we really want this, and so there's people running genuine factories out there that are like, if electricity price doubles, all of a sudden they can't sell their stuff, and it's coming into the other thing is it's coming into developed countries. So these data centers, I've just got another chart up showing. It's going to be about 50% of Japan's, keep in mind, Japan's got a falling population. They've got about 50% of their new electricity demand is just from data centers. The US is not far off 50. and it's coming in, a lot of it's sort of these populated areas. So there's this, it's more about the scarcity and the regional part. So the big picture of, looking back at the whole world is going, oh yeah, you don't need that much energy. But the problem is at the lower end, you're like, oh, actually we need lots of it in the right place. Lots of it in these places where that are quite concentrated. And then you go, okay, well, will these data centers just do their own energy because they can't connect? And the problem with that is, there's two problems with that. One is it's actually quite, data centers actually work really well with the grid. They're actually really helpful because data centers need lots of redundancy. And so if you're going to do your own power for your own data center, you got to build like 3 times or at least twice as much power as what you need, in order to get those redundancies. It's far easier to say, well, no, I'll plug myself into the grid, and then I'll stick a bunch of batteries or generators and stuff like that, and now I've got the redundancy and everything like that. So I think what you might see is them, they go, oh, I need 100 units of electricity. Maybe I'll generate 70 or 80 of them myself with solar and gas and whatever it is on the thing. And then I'll have a bunch of batteries that sort of, give me another 50 or 60. And so now I've got redundancy and I can run this, but I'm still need to be connected to the grid. And actually they're really helpful because they've got all this redundancy, all this spare bit. Now I can actually sell power back to the grid and buy, and help smooth out some of the peaks and troughs and all that type of stuff. So, so there's this, you absolutely need the power. There's this huge, there's blowout in needing in all the stuff, in that, stuff that used to take 3 or 4 months to come is now taking a year or more than a year. So it's on the critical path, but it's just not that important overall as a cost. And so, a real squeeze on the companies involved in this sector.
But there are some implications, right? Because if in fact demand for power is up, then achieving net zero targets and goals could be more problematic. The other thing is that data centers need cooling. Most cooling is actually done from water, and water actually become the scarce commodity that actually in the UK there's a really big debate at the moment, because there's an agreement to build some new data centers, and in fact OpenAI is part of that and some other people too. But the problem they've got is they don't have the water supplies to be able to provide the cooling to be able to make the build work.
Yes. And so this is one of these, this is this thing that your old data center, that's why the old data center and why NVIDIA is sort of really sitting at the core of this whole thing, is your old data center used air cooling. And so the issue for the new ones is that they're now much denser. And that's part of the reason why, part of this whole problem is your old model was, I ran a bunch of servers sitting on racks and I hooked them up with Ethernet cables and off we went. And whereas now it's like, no, we're jamming everything in. It needs to be as close as possible because we've got everything sitting really close so that they can load half the internet into its memory in order to be able to run all these calculations on it. And it's all about the speed of calculation. So because you're doing that, now you need to get cooling into a much smaller space and you need way more power per square meter. So, you used to be, okay, I'll build a data center and they've probably got the right power or close to it, already there. I can just plug myself into the network or whatever. Whereas now you're like turning up and going, well, I need, 5 times as much power as what you've got currently. I've got to build all this extra stuff out to get there. And so, and as we saw, it's like, and power is just such a small cost for it. So it's sort of, it's the cost that they're just prepared to pay more for. And so that pushes power prices up for others. And so, so there's that. I had something else I was going to talk about on this one. What else was I going to talk about? Cool. Sorry, I lost my train of thought.
No, that's fine. Let me just come back in, because this is a really important point, right? So there are consequences then for the rest of the economy, because everyone is going to be competing for that rare resource, energy resource, or that rare resource, water resource. And that means that consumers and other businesses could end up effectively paying more simply because of the fact that those in the data centers under AI have more capacity to pay than anybody else, because the margins are so much bigger and the growth prospects are much stronger.
Yes. Sorry, now I've remembered what I want to talk about. I want to talk about the overall. So who can you invest in this market for building this stuff? Because this is the interesting part for me, is there's some companies that are just doing the hockey stick growth, And you're like, what do these guys do? And they're like, well, they sell air conditioners. So, do they make them themselves? No, not really. They're just good at plugging them in. They've got some people who know how to plug them into data centers or whatever. And they're like, well, yeah, but those guys aren't important anymore. Now they've got the water cooling ones. And so I sort of put these into 5 buckets of companies. And at one end, you got the building companies. So these are the guys that are construction, real estate firms. These are your lead indicators for how things are going. And so what happens with these guys is, and there's a couple of big ones that they've got experience in it. What are they doing? Something really complicated? No, it's not particularly complicated at all. They're digging up ground and laying things, but they've done it lots of times before and they know how to do it. And so, there's lots of demand for them and everyone's trying to get them to do it. So these guys, I think of as a classic boom stocks. So they're going to be building these data centers. They're going to be charging, 3 times what they usually charge because everyone wants them. So their profit's going to look great. But when the boom ends, they're probably going to get stuck with a bunch of projects that just fall over and don't get done. Or don't, and then also their profits, they're going to go from 3 times to back to normal or below normal. And you just sort of that, you just want to be, if this is where you want to play, you got to be watching this really closely and just like, yeah, I'm on this boom, what's in terms of what's happening. The next stage is what we call the energizers. So this is like your power and cooling suppliers. So these are like, okay, so the first one, the builders, and they're the ones we've got a number of them. We're watching like their forward orders just go, is it still going? Is this boom still going? Yes, because they're going to be starting, 6 months before everyone else because they're lay foundations and, planning and permits and all that stuff. Then you got your energizers. Now these are the guys, a lot of them are, have got these either power or cooling supplies, and they're similar characteristics to above, but they're but a lot of them are just service companies. So the boom and the bust isn't going to be quite as extreme. It's not like they're say you're a service company and they're installing these things. Is it okay? I'm going to have to fire a bunch of people that I was charging out at cost plus double or whatever it was, and maybe my rates come down a bit, but it's not the same as I've got all this capital invested in it. There's definitely some of these power and cooling companies that just don't do anything that particularly interesting, but there's heaps of demand for their product, and so again they can just sell these things at way higher than what they usually could, and that's, you just got to be able to look at them and go, okay, yes, they're making whatever X dollars, but I just know that X dollars is going to be 1/3 of X. In once the boom finishes, they're only making X. They're only making that because they're just overcharging everyone for it. Okay, so that's your energizers. Now you've got your people actually with your picks and shovels players, your technology developers, TSMC, Nvidia, Broadcom. They're very profitable. I don't think these are the companies you got to worry about surviving. It's more about, I don't want to overpay for these things. I don't want to pay 100 times earnings. These are like your Cisco's in the internet boom. Yeah, they're still going to be around. They're still going to grow their profits, but you just don't want to be paying, 100 times earnings, 200 times earnings for these things. It's about trying to work out how long is this growth going to go? When have we got too high on it? And I think you're a lot safer in those ones than what you are in some of those above the builders and stuff like that. Then you got the operators, the people that are sort of like the hyperscalers and the property trusts. That's where I think scale is going to be a real advantage in the long term. So in the short term, this is where I was saying about Oracle. In the shorter term, actually the smaller ones are the ones going to go up the most. But in the longer term, some of those just aren't going to survive. Some of the smaller ones, but whereas the bigger ones will go from making lots and lots of money to being really, really profitable to just being really profitable. And then finally, you got the open AI, the sort of the AI architects like your OpenAI, Anthropic, all these ones like that. Now they're not profitable at the moment. No one would even think of trying to run a profit on these things for years because they all just want to grow as fast as humanly possible. If you're making a profit, you're wasting money. You should be spending more trying to beat everyone else. Is basically the idea with those ones. And so you probably can't invest in any of these. These things are mostly unlisted. And that's part of the whole problem with this is that at least in the tech boom, we could see most of things because people would raise money. We would then look at the accounts and they'd put the money in and where they're spending it and, all that type of stuff like that. You could see it. There's so much of this is just unseen in terms, and I showed you some numbers before, like they're guesstimates. And we've got, there's all these unlisted companies that are we just don't know what they're up to. you can see the press releases, but what's really in a press release? How much do we know that's real and how much of that's just hype? So yeah, it's and with all those companies, the way I'm thinking about them all is, look, what's a reasonable normalized sort of earning base when the boom finishes? And so, if you're a construction company, you're going back to normal construction rates. Once the boom finishes, you're not going to be able to charge double, triple, quadruple what you used to charge. There'll be other construction companies that can do the same. They can lay foundations. They can plug stuff in. You're not doing anything. It's great at the moment. You've got the experience, charge for it, but you're going back to normal. And so that's one. The second part, though, and probably the more important part when you're looking at this is, particularly for some of the ones, say the TSMCs and all that type of stuff. Well, can demand still double or triple before we get there? Like, so is this going to go from, I think you're going to finish, say, at NVIDIA, it's going to finish up with a sales of whatever, Y. But is that going to go up 3 times first and then fall back down to Y? Or is it going to, is it already at Y? Is it, where are we on that scale, and how much you're prepared to pay for it? Because that's that's where your the real guesses that we're trying to make at the moment in terms of this.
And that's going to be very much driven by precisely how much AI is ultimately embedded in normal business processes and change business processes, both in the public and the private sector, right? And there's a lot of waffle around that at the moment. I'm not convinced I'm seeing a huge amount of revolutionary change so far in a lot of those ordinary businesses. But if they actually are able to drive substantial savings, or indeed offer new products and services, then the growth trajectory could be quite strong. I suppose on the other side, if in fact it's a myth, and basically there is not a lot out there in terms of real outcome. And there was a report quite recently produced, I think, what was it, by Moody's, I think, that suggested that there was a lot of talk about it, but not a lot of real substantive change yet, anchored in real businesses yet. And if that continues, then the trajectory will be rather different.
Yeah. Now, 2 things for that. One is, that's not dissimilar to the internet boom.
Yeah.
Like, so you were, banks were a great beneficiary of the internet boom. Yes, we're going to get everyone doing online banking. We're going to get to close all these branches. We'll save all this money. It's going to be fantastic. But for the first 10 years, they got to save no money. They had to keep their branches open because everyone was still using it. Everyone was like, and the people who were using the internet banking was like, yeah, I can use this internet banking for 80% of stuff, but the last 20% I still need to go. So you need to keep your branch open. Plus, you needed to build all your all these servers and websites, and I need to hire all the people to do all this stuff. Actually, the cost went up in the short term, and then at some time in the long term, they went back down again. So that was, and I think that's very similar now. And I think but I think as well, importantly, at the time you could see, well, okay, I can see competitors getting this up and running. If I don't try and do it, if I just say, oh, I'm just going to save the money, then I can see that they are, eventually they might get it right, and then I'm toast. And I think that's where you're looking at these ones. Let's say that insurance example I used. If you're looking at this and going, well, we can just take photos and get the AI to do the insurance assessment for us, and now we don't need, now we need 20% of the insurance assessors. Yeah, at some point you can see the outline of that working. Do you trust it at the moment to fire 80% of your insurance assessors? No way. But you can see where, okay, if I'm in that position and everyone else is doing it, and I don't have something in that, if I don't try, then I'm going to lose out. And that's where I think a lot of this benefit is coming from.
Well, well, let me talk about the psychology of this, because that's interesting. Now, I was working in a very large bank in Australia in the sort of the 97, 98, 99, 2000 period, right? And that's when the internet was beginning to take off. And I was responsible for trying to figure out what the digital impact to banking would be over the next 15 to 20 years, right? And I sort of argued that there would be a transformation ultimately to a world where you wouldn't need as many branches, that cash would be less important, etc., all of that sort of stuff, which we now sort of see today. But the psychology of those leaders at the time were, well, we need to be seen to be doing things, but we don't want to spend very much on it, because we're not really convinced that it's really going to be as radical and revolutionary as you're saying, right? And so we'll just sort of paddle about in the edge And they had a wonderful excuse because Y2K was also coming up at the time, and they were worried about their data centers falling over. So rather than investing bigger to take a more strategic position in terms of where the digital world could take us, now they said, well, what we'll do is we'll do a little bit to show that we understand what's going on, but we're actually going to make our big investment in Y2K that really didn't go anywhere, right? So there's this really interesting psychological issue here in the minds of many executives in corporations, not in AI land, but in real land. And I wonder whether we can see the same thing again.
Yeah, well, and I want to use the example, and something for people to think about is that, if you go back to, the 90s, late 90s, and or maybe very early 2000s, and you're a director at, say, Fairfax, and you are making truckloads of money from employment ads, from car ads, and from housing ads. That's sort of your key parts. And someone says, "Hey, there's this site called Seek that's doing, undercutting you on employment ads. There's this other site called car sales, and there's this other site, domain or realestate.com.au. They're selling stuff, the same stuff you're selling for $200, they're selling for $20 an ad or whatever it is. I think you should transform your entire business, cut your sales by 80% and compete with these guys." You'd be laughed out of the boardroom every time. Like, it's just like, we're making billions of dollars. These guys are selling. Why would we want to cut our own margins by that? And you could have had that same conversation every couple of years, all the way up, until eventually these guys are taken over, and they're the ones now charging the premium prices for to put people on their sites. And if you look at the market cap, you go, well, the market cap of Fairfax at the time versus the market cap of these other ones, and then eventually, it's roughly the same size as the industry. It's just that it all transferred from one company to the other company. But you can see how at every step of the way, the old guard was just like, well, maybe it won't happen. And also I have to give up a certain amount of money that I'm getting right now in order to get this uncertain amount of money somewhere in the future. And so that's certainly front of my mind is, what other companies are being affected by AI at the moment that are having going through that same process and going, well, I can see this coming, but I really don't want to give up that juicy profits that I'm making at the moment.
Well, it's a very good point. And, going back to my earlier case study from my experience, I actually, in the late 90s, was talking to a very large technology company, obviously in a big bank, and also a digital media company as well, very large one. And the technology and digital media and the bank got to start to see that there was an alternative future, which was about investing in networks, investing big in networks to take a sort of a foundational position to be able to create a new paradigm, right? I mean, that was what the conversation was. But at the board level, it was like, it was a snooze baby. Nobody wanted to touch it. Nobody wanted to actually break out of the mold of current mode of operation, because why? It was fundamentally very profitable at the moment, right? And this was a more risky strategy. And no, we don't take risks. We're a bank. We don't, So it was a really interesting. And I come back to this because I do think the psychology is really, really important, right? Both in terms of the psychology of risk and the psychology of needing to react or not reacting, leaving it too late, the Kodak moment, for example, and then being, out evolved effectively. So I feel we're in that sort of same environment now, but I suspect that the true adoption of real benefit from AI will take longer, just like the use of the internet took a lot longer than a lot of people thought. And along the way, there will be a number of casualties.
Yep. Let me pull up my Gartner hype cycle. I'm sure I've shown this on yours before, but always
yeah. Love it.
Through this technology trigger at the bottom, peak of inflated expectations at the top, before you fall back to the trough of disillusionment, then slope of enlightenment to finally you actually get. So you end up way up from where you started, but it goes through a big peak first. And this is the question, are we, some people are like, oh, we're pretty close to the peak. And I'm like, I don't know. I think there's I can certainly see, I mean, I'll give you my example of, could this happen? And then we should talk valuations for these things, because I think that fits right into this. But, let's say the US goes into like a reasonably sized economic slowdown with tariffs and, all the craziness that's going on. So you get stocks most exposed to the consumer all get hit. all your sort of moderately priced sectors, get these big earnings downgrades and stock prices fall. The Fed cuts interest rates. The tech sector keeps spending on AI. Now they've got lower interest rates to do it. Now they've got other builders not building stuff because there's a bit of a mild recession going on in the US. And so now you're not competing as much for some of the resources you needed to do this. And maybe some of the electricity demand's a little bit less. And so you're actually helping them. As long as capital markets stay open, we start getting all these AI, all these private ones now start saying, oh, we've got to get rid of these companies we bought a few years ago. Let's sell them to the public at these inflated IPO prices. The inflated IPO prices go ahead. The companies then take that money and plow it back into more calculations, giving more money to these data centers and Nvidia and all this type of stuff like that. Under Trump, you've probably got very little antitrust activity in the AI sector. And actually probably under any president, but more so under Trump than others. He's certainly not pro antitrust things. That sort of double negative positive makes sense. And so most of the benefits end up accruing to the largest companies who are then free to sort of buy up some of the smaller competitors that they think might threaten them. And so the large tech companies end up with higher profits. And so is that where that's probably a good jumping off point to say, well, what's the valuation? Up those charts. Oh, sorry. Because this is the part which is really fascinating with the market is the valuations, and this piece is out. I just put this out yesterday, and so again, you can jump in and download this from the show notes link. So I've got a chart up just showing the forward PE for financial resources for the market. So it's similar to highs to where we were post pandemic, and it was only ever more expensive during the tech bubble. So that's where we are. Now, I want to stratify this and break it up into like 4 different buckets. And I've got the chart just showing up the how I'm going to do this. So on the left, I'm showing the number of stocks. So I'm going to take the biggest 2% by number. And that's actually going to make up 37% of the market by weight because these stocks are just so much bigger. Then I'm going to take the next 18%, so bring it out to 20. Now that's going to make up another 36%. So just as, we were up to 72% of the market by the time we got there. You got the middle 60% of stocks. Now, and when I say stocks, I'm talking about the top 1,500 globally, which is it's like 80% plus of the world market. So that middle 60%, whatever that makes up in terms of number of stocks, like 900 stocks or something like that, it actually only makes up 25% of the overall market. And then the smallest makes up 2%. And I say, okay, well, let me do that. And those, having said that, those ratios do change over time. Sometimes the bigger stocks don't make up that much and all this stuff like that. But if I do that and then look at those same ratios, now I go, okay, the top 2% of stocks are trading on 29 times PE. Like they're clearly expensive relative to the last 25 years and similar to how they were in the tech boom. But all those other sectors are sort of about average. Like they're maybe slightly above, but they're certainly not out of sync in any major way with where they've been for the last 25 years. And so it's that real story. Okay, do I want to buy an average price stock that's about to run into it's potentially about to run into some economic downturn and struggle on terms of earnings at 15 or 16 times? Or do I want to buy one of these stocks that actually looks like its earnings are going to be pretty steady and grow and all that type of stuff, one of these massive ones that's actually making pretty decent profits at 28 times or 29 times? And it's a reasonable it's a reasonable sort of, okay, what level do I start saying no, that's too much to pay, and what level do I think that's the right sort of difference in price? And I will come back to this answer, but I just want to touch on 2 other things quickly. Is one is actually, if you looked at today and said, tell me how many cheap stocks we are, so less than 12 times forward PEs, and you go, right now it's about 26% of the market. So that's reasonably above where it was in 1999, sort of pre the tech boom finishing, and 2006. So it's sort of, while prices are high, there's certainly a lot more cheaper stocks out there. And even if you sort of picked a more moderate time like 2016, 21% of stocks were traded below 12 times forward PE. And the average PE for the market at that time was much, much lower, was more like sort of 16 or 18. And we've got so there's sort of like we've got these couple of really expensive stocks at one end, and then all these really cheap stocks sitting at the other end. And so then you go, well, what about the sectors? Because that's sort of interesting as well. Is if you look at the what I call high PE sectors. Actually, let me start at the other end. The lower PE sectors, financials and resources, tend to trade on lower multiples. The resources just don't have control over their own prices. They've got their commodity products. Lots of capital needs to be spent. They trade on lower price to earnings ratios. Banks are really, really leveraged and constrained from governments. They trade on lower PEs as well, typically. And then you've sort of got your manufacturing guys sit in the middle. And you say, well, back in 2000s, when we're talking about all these prices, sort of mid 2000s, 10% of the market was tech. Well, sorry, less than 10% of the market was tech. About the same amount was these medium PE sectors, and about the same amount was the high PE sectors. But now we've actually got, it's sort of like as if, okay, if it just happened to be that the top 20 or 30 stocks in the world also happen to be in the tech sector, then you would naturally expect the PEs to be a bit higher, because you just pay more for those stocks because they've got more stable earnings and less debt and these other things like this. And so yes, you've sort of got this sort of natural sort of sector-based bias. And then you say, well, is there more growth coming from, so if you go, is there more growth coming out of this top 2%? And you go, yeah, the answer is yes. Well, certainly on a forecast basis, it's sort of probably 4 or 5% extra growth. And so you go, okay, well, so they're growing faster, so I'm prepared to pay a bit more for them. They're a higher quality type of stock, so I'm prepared to pay a little bit more for them. And then, and how much more? And so the other thing I wanted to go is just say, well, if you look at, say, so forget size. Now, if I just go back and say, let's look at the median stock. So basically, if I lined up all the stocks and said there's 300 stocks in the tech sector, what's the 150th stock? What's the PE on that? And same for the consumer sector, resources, all that type of stuff. And that's the chart I've got up showing at the moment. And the tech sector's like, it's a little expensive on that basis, but it's been expensive for the last 5 years. It's not any major. It doesn't look like the same as the other chart. All the other sectors look, about average. It's sort of the median stock in these sectors is trading about average. And so, that real question then comes back to, okay, how much more am I prepared to pay for these large stocks that I think are going to benefit from that whole, this whole cycle? How much more am I willing to pay for that than others? And so I'll use there's hundreds of different ways you can do this, but let me use a sort of a simple-ish example. Is they've said, okay, well, let's use a discounted cash flow, and let's say that these companies are going to grow for 10 years. They're going to grow faster than the rest of the market. And then after that, everyone grows at the same rate. We just don't know what's happening. 10 years is a long time. So, who knows what's happening after that period. So if you do that, I'm going to stick these things on. I'm just going to say, anyway, there's a bunch of other assumptions I'll put into that. But really the only real difference is how much faster for that 10 years will the stocks grow to justify today's prices. And the answer is about 9%. So if say the rest of the market does 3% and tech stocks grow at 12% per annum, or the rest of the market does 5% and the tech stocks grow at 14% per annum for that 10-year period, that would justify today's prices. And then if you actually went back and went, well, these tech stocks, especially the big ones there, they don't have any debt. They've got high margins and stable earnings and all this, some of these benefits you look from them, is you go, well, you could probably then argue, maybe the discount rate's not quite as high as some of these other ones. You could argue that, you probably only need about a 6%, 5 or 6% higher earnings in that sector in order to justify it. And so, is that reasonable? Well, it's not too bad. I can certainly see scenarios where that's gonna happen. So I'm not saying I'm like completely convinced this is the way, but it's also the part about saying, well, I'm enough convinced to be mostly invested in terms of equities, but I am convinced as well that this is the right lens you need to be looking upon this. You need to be saying, take this AI stocks, that the ones that are really benefiting from it, understand how they're benefiting, which are the ones that are where are the profits ephemeral and where might they last? And now, how much am I prepared to pay for that? How much do I think these stocks are going to grow faster than ordinary stocks? Then now I can work out what's worth buying and what's not worth buying. Because one way of sort of avoiding it is you go, well, you know what, I'm just going to avoid that whole sector. I'm just going to buy all these stocks that are like average priced. Let me buy the rest of them. And that's great as long as we don't run into some sort of slowdown where the earnings suddenly falls, 10% more than what you think. So yeah. Anyway, that's how I'm thinking about this. Right back to you, Martin. I know I've been sitting on the soapbox for a little bit.
No, that's very interesting. But I guess one of the questions I've got is that there is another sleeping issue here, and that is the bond yield question, right? So we've got indications now that bond yields are continuing to rise again. They were up, then they came back slightly, but they're up again. Japanese bonds are very extended at the moment. US bonds are up as well. So the cost of debt seems to me to be another critical question here. And if you actually overlay the issue of, well, who's leveraged and who's got big debt, there's actually quite an interesting correlation. You often find that some of those lower yield stocks that you spoke about actually have much more exposure to debt, which suggests that if in fact the debt conundrum continues to rise and the cost of debt rises, that means that they could actually be under more water relative to some of the tech stocks that are really not worrying about debt because they're swimming in funds at the moment.
Yeah, that's right. Coming back to that. Okay, so let's talk bonds for a little bit. I mean, and it's, you have to mention this. The latest thought bubble we've had from Trump about maybe I have to send everyone a check for $1,000.
Exactly.
Let's go more into debt in order to spend money, to send money out to the consumer, and that's the type of thing I think where you're seeing bond, especially at the long end, we're seeing bond yields move up a reasonable amount. And now it's sort of the mid part is sort of people going, well, if that's the new view of, like if you even Trump version 1, if that was his thought was, hey, why don't I send out a bunch of checks to, we're spending all this money, why don't I send out more checks to everyone? Is half the Republicans would have been up in arms, and your Paul Ryans and all that type of stuff would have been, this is, no, it's crazy. We're never going to pass this. Whereas now everyone's like, oh well, let's just, if it's what Trump wants, it's what Trump wants, So I think there's a recognition coming from markets of saying, well, look, we need to take this stuff seriously. Like if debt deficits no longer matter, then we can expect inflation. If deficits no longer matter, we can expect politicians will then spend more money, and then we'll have higher inflation. And a lot of this is who's going to get it, and it will matter. Like this is the, in a large way. If you think about the economy as being households, governments, and corporates, is that when and sort of you got those three sort of working together, sort of making up the economy is when governments decide to go in bigger deficits, that money ends up either in households or in corporates. And at the moment, it seems to be ending up mostly in corporates under sort of Trump's original parts. But if you start sending out checks to households, well, okay, it's going to more of a ending up in households. Okay, now maybe I'm buying some household stocks, some stocks that benefit from that instead. So, who benefits from it will make a big difference if you go through this things like that.
Yeah, and of course the $1,000 check from the government is getting around the Fed not cutting interest rates, right? It's another way of doing the same thing that Trump wanted to do without necessarily having to get the Fed to cut rates. And I would argue it's probably inflationary, which means that there's probably a lower chance, if it were to happen, of interest rates being cut.
Yeah.
And the forward signals are inflation is still not dead, which means that interest rates probably will be higher for longer than many, which comes right back then to going back to your valuation question. There are some sectors and some stocks that are actually highly leveraged, and therefore, if they have to pay more for their debt, are going to find it more complicated in terms of being able to actually make those higher returns. So that's a big complication, which also takes us to the other point then, and this was the debasement conversation. So JP Morgan put out that paper, you probably saw it, which suggested that it's interesting that retail investors are now FOMO'd on the gold, and FOMO'd on the silver, and FOMO'd on the Bitcoin. Why? Because they're now worried about the debasement, because of the high debt and the weaker dollar. And my reaction to that was, well, it's been going on for some time, right? This isn't suddenly a new issue. This has been a long-term issue. So it's interesting to me that JP Morgan would bring this out as a sort of a revolutionary insight.
Yeah. Yeah, that's right. That's we've spoken before in the past about gold being an anti-US dollar, and so yeah, debasement for currencies is good for gold. And it is also worth noting though as well, and I'm sure I've done this in the past, is that the demand from countries is much larger for gold as well. So, if you went back even 6 months, sort of maybe not six, yeah, pre Liberation Day, um, countries like say Brazil or on the periphery of the US would be like, yeah, we don't, Trump's talking about putting tariffs on. We've actually got a huge surplus with them. Um, yeah, we've seen what happened to Russia and seizing Russian bonds, but or Russia seizing Russian assets, sorry. But we're pretty close. We're not planning on attacking anyone anytime soon. Yeah, sure, we'll keep investing in US dollars. Not a major issue. Now all of a sudden they've got 50%, and they're like, Trump's there's a bad thing. What else can I do to them? It's like, well, even even as a sort of not a major ally, but certainly in some way aligned, they're now going, well, okay, maybe I shouldn't be putting as much money into US bonds. Maybe I should be, if I'm thinking about buying reserve assets, I need to diversify and get other things. And that's a country that's relatively close. Let alone all the countries that are sort of, further away on the periphery is like, so I can certainly see where does the demand for gold end up? Look, I don't know. Yeah, it's a tough question because there's certainly uh, it does look it does look bubbly, and we're certainly on this. It's been on this this exponential growth and all that type of stuff like that. But by the flip side, you're like, well, what's the catalyst that's going to bring it back? It's hard to see what's going to bring it back to lower levels.
Well, not least because a lot of the purchasers are central banks, and central banks are buying gold not because of the price or trading, but because of this strategic view about insulating themselves from risks or deleveraging themselves from the US dollar, which means that their propensity to go on buying, even if prices go higher, are actually quite strong.
Yeah. And then the other part that you get from some of this is in some of this debasement is you're like, okay, so we're talking about higher inflation and we're definitely talking about maintaining at least this the inequality part where rich people getting richer and poorer people are spending all their money, and that often happens during inflationary periods. Is the poorer people will end up seeing that their costs are rising faster. They're just the types of costs that they have, and so if we're still looking at this part where the rich are getting richer, so therefore they're investing more, is that they're pushing their capital somewhere and chasing every asset they can, whether it's housing, gold, Bitcoin, stocks, whatever it is saying, well, what else can we bid up? If we haven't got this, we've got this spare capital, we've just got to invest it somewhere.
Absolutely. Well, let's just migrate the thought forward because, of course, the shutdown is happening at the moment, and there's a bit of debate about, markets don't care about a shutdown because generally they don't go on very long and it's not really going to be particularly troublesome. I want to sort of pose a slightly different thought. Maybe it's quite convenient to Trump to have a shutdown, partly because it gives him more powers to do things, and partly because, over time, the implications of the shutdown will get more and more serious, and therefore maybe other people will blink. But at the moment, are you sort of factoring the shutdown story into your strategy or valuations, or are you just saying, "Oh, well, let's see how it plays out"?
Look, we're certainly factoring it into our thoughts on the speed of the US economy outside of that tech sector. And I think it's a little bit like those debt levels where it doesn't matter until it does. Yeah, a 5-day shutdown or a 10-day shutdown is like, well, it's obviously not pleasant for anyone involved in it, but there's some damage done, but I think the damage has been done in prior cycles in terms of it's not the first time it's happened or it's not the first time it's been for this long, and so it's sort of like it's almost as if some of the shock effect is no longer as great as what it once was. But at some point it can start tipping things tipping things over. That and I think I do think Trump's belief is that um, it it isn't as important as everyone thinks, and he was probably proven right the first couple of times around on that. And I think he's probably willing to push that thought further. And if he was wrong, he's going to send out stimulus checks to everyone. So sort of like, oh well, I'll take whatever I can, and actually, I like doing whatever I like being able to do whatever I can, and anyway, and so maybe he gets some more powers under this that he wanted. So yeah, I think I suspect he certainly will be interested in pushing it as far as he can. The question is now, how much pushback do Republicans get um, from their constituents?
Mm.
Or are they successful in saying, no, it's all the Democrats' fault, despite the fact they've got minorities in both parties, it's their fault, and we're going to blame them for it, and they'll eventually fold. So, yeah, I don't know, but it's certainly I wouldn't be ignoring it as an issue in how you're putting things together, and it certainly fits centrally into that whole theme I was talking about, saying, well, you can see like an extended shutdown making, taking a lot off, say, consumers and some of these other companies. Is it going to slow the AI boom? I don't know. Maybe it's just going to give it more room to lower interest rates, to borrow more money and raise more capital, more room to grow. And partly that was the tech boom. There was obviously the as you said, the Y2K thing going on. But the other big thing that sort of helped drive the tech boom that sort of sometimes forgotten is long-term capital management. So a big hedge fund was doing some really weird stuff and sort of almost brought the financial system down in sort of 98, I think it was. So just a couple of years before. And we saw interest rates get cut. And that was part of what was really drove that whole tech boom, was that lower interest rates pushing where's that money going to go and all that type of stuff has pushed it up. And this whole idea that in low interest rate environments, I'll take higher growth. And so maybe that's what the same type of thing for the tech boom is. You end up in that same similar scenario: interest rates getting cut, weak economy, and tech stocks booming.
Absolutely. Well, we'll obviously see how that plays out. But it's worth, I think, reflecting. We've been spending a lot of time talking about the US because the US is such a large economy and a lot of investment funds have gone into the US. A lot of superannuation funds from Australia have gone into the US. And there was a report quite recently suggesting, the RBA suggested, that maybe some of that superannuation funding in the in the US was actually under more risk, particularly with some of the adverse effects that could happen, which I thought was quite interesting. But the local Australian economy, there are some interesting signs there. So the RBA said that the consumer was a little bit more willing to spend, although the latest confidence data from consumers, I saw it today from Roy Morgan, was not very positive. And the latest data on jobs openings was also down as well. So there are some sort of worrying signals, I think, in the Australian economy. And looking at the mix of stocks in the Australian economy, we still have that same sort of diversity in terms of some with strong PEs, some weak. But of course, it's nothing like the AI distribution in the US. You got a few banks that are still quite strong, like CBA. My suspicion is, I could be wrong, but there's nothing that would suggest that we should be pulling away investing in the US at the moment relative to Australia.
Yeah, there's a currency issue. Obviously, if the US is hell bent on debasing its currency, then that probably means the Aussie dollar higher and the US dollar lower. So that's gonna economic profits. I think the other thing though, and while I have some sympathy for this idea. Okay, look, it's much more concentrated from a global perspective. There's a lot more of the market is in the US at the moment. But also on the same track, a lot more of the US is investing internationally. So, a lot more of the companies in the US are investing internationally. So when I think of a company like, say, CSL in Australia, I don't think it's an Australian company. It's a global company that happens to be listed in Australia. BHP, Rio are the same. Like they're global companies. They happen to be listed in Australia. And that's the way I think about a lot of the US companies as well, is that, yes, they are notionally US companies, but Microsoft makes money from right around the world. Google makes money from right around the world, mostly Ireland, for some strange reason. Yes, but there's they they're global companies, and so um, you know, I don't want to get too caught up in the happenstance of where they happen to be listed. And I'm sort of more interested in trying to pass. Okay, what is happening to these global companies, and then you can look at individual Australian companies and go, okay, here's a company, whatever, a JB Hi-Fi or a Woolworths or something like that, and say, okay, this is a genuine Australian company. It's mostly, in Australia. Okay, that's affected by what's happening in Australian markets, and looking at it from that perspective. So, yeah, I think when you're looking at the Aussie market, I would be the buckets I tend to look at is saying, okay, I want to get resources and think of that separately. I want to have the financials and banks in particular and think about those separately. And then of what's remaining, I want to then go, okay, well, what's actually an international company that happens to be listed in Australia? Brambles, CSL, those types of companies, James Hardie, or what are the companies that are actually genuine Australian industrials left in that? And that's sort of the four buckets you should be thinking about. How am I invested? Which ones do I think are going to grow faster or slower? And how, what are we doing about each of those?
Yeah, very good. And of course, the whole question of degree of diversification, different industries, different geographies, all of those things. Because generally, I think the advice is spread your bets a little bit. Don't put everything in one bucket. Don't just go for one asset class on the principle that you might be right, but you might be wrong.
Yeah, absolutely right. And also as well, that this is this part of that. If I was a financial advisor in the US or the UK or Europe or Japan, anywhere like that, and I turned up, somebody turned up to me and I said, you know what, I'm going to stick 30 odd percent of your money, or 20 or 30% of your money into resources. I'm going to stick another 30 or 40% into banks, and I'll buy a little bit of other stocks with whatever's remaining. Like if I got that wrong, I'm getting fired and sued for financial mispractice and all this stuff like that. That's an Australian portfolio.
Yes.
That's what we buy. You turn up and go, yeah, I'll buy the A600. You're like, that's what you've got. You got 20 or 30% resources, 30 or 40% banks, and yeah. And so, resources make up 1 or 2% of the world economy. So, I think just you shouldn't be looking at Australia and going, well, I have to match the ASX 200 because that's what I want to do. You should be taking a bit of a step back and saying, well, do I really want a massive exposure to resources at this time? Sometimes the answer will be yes. Often the answer will be no.
Absolutely. Well, by definition, the Australian market is myopic, right? Because of the reasons we've just said. And the final question, just briefly, active versus passive. There's been a lot of conversations about the fact that more and more and more funds are invested passively, which effectively accentuates market movements versus active. Are you seeing that in your conversations with your clients in terms of active versus passive, or is it not a big deal?
Look, it's a deal. Yeah. So I mean, we offer both, and so we have so we've had more of both, more of active, passive, maybe. Our active funds have been all right. So that's probably been, I think for individual managers, if your active funds are outperforming, then you don't get as many of those stories and the other way around. But I guess one of the things to think about from this is, why have passive funds been doing really well versus active funds over the last sort of 10, 20 years? And one of the big reasons why is, well, actually, the biggest reason for most of this is fees over the long term. You want to make sure you're getting whatever extra returns you're getting, your active managers aren't taking it all back. So someone like ourselves might charge like 0.6 more than in terms of run the active funds. There's plenty out there that run like 2% or something like that, or well over 1%. And so what they do is they might outperform by 1%, but then they take it all back in fees, or they might outperform by 1.5 and take it all back in fees. So you want somebody who's charging, the outperformance is at least you're paying for what you're getting. But sorry, the bigger issue though that to think about for the last while is exactly what we've been talking about, is the large caps outperforming. So, and I'm going to use an extreme example in this one, but Denmark, they had a Novo Nordisk there became, I think it was 50 odd percent of their market, more than half their market was in this one stock. None of the active managers could buy 50% of it. So they were maxed out because, as an active manager, you're like, okay, I need to spread my bets around and all that type of stuff. Like I might be able to buy, 20% of one stock is like a massive bet for you. Our typical holdings are sort of like 2%, in stocks. So none of the active managers could match the index. And so the index kept, while this stock boomed and went up, and they all underperformed, and the passive stocks all outperformed, and it's like, oh, see, passive is way better than active. And then then it fell, and then all of a sudden the active managers are all outperforming, and the passive ones are underperforming because of this one sort of decision that, if you're investing in that stock market, you've got one massive big stock. And so I think knowing the structure of what you're investing in, and the fact that so what we've seen is that passive funds have been more invested in these larger stocks because that's what they're the ones that have been going up, and so that's what's really been driving it. I actually think, from my perspective, I've spoken about the pros and cons and whether it's going to go up, and we're still pretty invested in most of these sectors. There's a reasonable chance that goes on for a while. At some point, that'll turn around. I don't actually think it's going to be in the next year or two, but at some point it will turn around and the larger stocks will fall more. And then you'll get to have all these active investors talking about how great their performance has been because they they didn't have 10% in Nvidia. They only had, they had 3% in Nvidia or didn't own it at all because they were busy buying small caps and medium caps. And so, there is a reasonable amount of, obviously not from us, but there's a reasonable amount. You get your performance, and then you just, okay, how can I perform? What can I compare that to that gives me the best, puts me in the best light? Like, it's a natural thing for everyone. And I think, you'll see that at some point that'll turn in terms of performance. But at the moment, it's, the tailwinds are certainly behind the passive part, just because when you are doing it, you are getting that big exposure to tech, whether you want it or not.
And my takeout from today's conversation is that as we come into the sort of the final quarter of the year, markets tend to run a little higher. There are some significant reasons why markets may well run higher because of the tech that we touched on, and so that's certainly a scenario that's quite plausible. But there's also a bunch of risks, the debasement story, the debt story, the trade and tariff story. So we are still, I think, in a quantum of uncertainty in all of this, which suggests that a little bit of caution is also important when you actually think about how you build your portfolios and how you actually position. What if you're wrong?
Absolutely. And now is not the time to, if you are actively managing it, now is not the time to say, oh, you know what, I'm off for 6 months. I'll, hopefully everything will be fine in 6 months' time when I get back. It's saying, if you're going to actively manage it, now's the time you need to be watching the closest, because there is a lot of landmines out there. You go, yes, we navigate those. I gave you that bull scenario of where we end up with tech much higher and the rest of the market, whatever. That's there's 100 other scenarios where Trump goes too far on something, the government shutdown goes for too long, and the US rolls into recession, and then the capital markets close. If the capital markets close and all of a sudden you can't raise money for all this AI stuff, then the AI will come to a pretty fast stop. I think there's, and I think there's, I've sort of posited that as, does the AI boom in a bang or a whimper? I think it's probably more likely to be a bang. So I spoke about watching these stocks that are out building the data centers as one of these first order indicators. I'm watching it because that'll tell you if it's going to finish in a whimper. So if we sort of end up, they just start slowing down and gradually everything runs out of steam and then the whole cycle sort of rolls over, that's where you'll sort of see it first. It's more likely, though, that everyone's just raising all this capital and free money everywhere, and everyone wants AI, and private equity guys are throwing money at it left, right, and center, and then trying to list the companies, and then all of a sudden the capital markets start to chew up. Some AI company somewhere loses a lot of money. Everyone starts thinking, oh, maybe I won't invest in the next one, and I've already got lots of exposure, and then bam, all of a sudden everyone's like, well, if my revenue was coming from these people raising money, and so therefore I'm not going to build this data center, and because that guy doesn't build, the next guy doesn't, and because that guy doesn't, all of a sudden Nvidia does an downgrade of its earnings, and the whole thing goes into reverse. And so I think that's probably the most likely scenario. Is it going to happen in the next 6 months? Doubt it. Is it going to happen in the next 5 years? Probably. Just the question is where, that time frame.
Timing is everything. Timing is everything.
Absolutely. And so you could take a view, and so you could take the view that, hey, you know what, I'm just going to step out of this and I'm going to go to the cash and I'll come back later. or you can say, well, look, I think there's a reason to be at least cautiously invested, but monitor everything. And I think that's where that's where we've taken it. Is that cautiously invested, monitor it, keep watching. Company earnings in particular, really, really important, and the earnings of these stocks that are highly priced. And so that's the way we're treating it.
Damien, well, thank you very much. Now, just to underscore a couple of things. Firstly, if you're interested in Walk the World Funds and Nucleus Wealth, there's a link below. You follow that and you can actually find out more information. And there's an extra link as well, specifically to your AI report, which is effectively a more detailed version of what we've discussed today, and it's available for download. So folks, go and download it.
Super. It's called.
Sorry?
Are the robots coming for your super? I think we've got a nice big picture of a Terminator there somewhere.
Are the robots coming for your super? What a great question. we should have put that in the thumbnail as well. Anyway, I want to say thank you very much. Very, very insightful from you, Damien. As always, thank you very much. Appreciate that. Love the new setup there, by the way. People are commenting on the on the new audio, etc. So that's great. And I'll look forward to doing it all again next month if you're okay with that. Seems to be that it's a good time to have another conversation and see where we are. Expect the unexpected. Markets are all over the place, but nevertheless, there are still opportunities if you actually know where to find them and where to look. And Damien and his team can certainly help. So, Damien, thank you so much.
Thanks a lot, man. We'll speak next time.
Okay, take you offline now. See you later. So there you go. I hope you enjoyed that. Very interesting conversation, Damien. Always great value. And follow the links and find out more about Nucleus Wealth, Walk the World Funds, and of course also download Damien's report. Next week, it'll be me, and I'll be talking about my latest analysis, particularly on household finances, and try and actually debunk some of the waffle that's out there, including from the Reserve Bank in terms of the status of households and what's going on. So that should be interesting. The dogs are still here. They did come and give me a nudge a couple of times to say, haven't been fed yet, but they've gone back to sleep. But they're now getting twitchy, so I think it's lunchtime for the dogs. And I want to say thank you for spending time with us this evening. Jason, thank you very much. Super chat, really appreciate that. Always helps, of course. And I really want to say thanks for helping to support what we do here. Really appreciate it. So that's it. Have a good week, and I'll see you live next Tuesday, as always. And meantime, check out the recorded shows. We put shows out each and every day, covering aspects of property, finance, and all of those things. So check those out. This is Martin North from Digital Finance Analytics. Take care. We'll see you next week. Bye.